I've got Spotify, so do you, and the Wall Street Journal knows it because it reports that Spotify dominates audio streaming. But it also asks, where are the profits from all these premium members and all those ads it's serving up? In this explainer, let's talk about where a company reports its profitability and what financial statement shows that. So to begin, we ask, what are profits? And we have three elements that I want to bring to your attention here. When we think about profitability, we need to think about revenues. Revenue is the money that comes into the business. But then we need to subtract from that our expenses, or the costs that we incur to run and operate our business. And the difference between these two, revenue minus expenses, gives us what we would call our net income, or our profit. This is also something that you would find on a profit and loss statement or an income statement. And so here we're looking at Spotify's income statement. They have to report this because they're a public company, and because they're a European company, but they're actually also available for trading here in the United States, they report this information to the SEC. It's listed in euros, but that doesn't matter, the currency for our purposes here. What do we want to look at? Well, how much money came in based on Spotify's business? When we look at their revenue line, it's 11.7 billion euros. That's money they receive from subscribers like me or like you maybe, and ads that they served up to listeners like you or me. So that was the amount of money that came in. But from that, they had to spend a whole bunch of money. And you can see they have the cost of revenue. That's like royalties and licensing. They had to pay a lot of money to artists and studios, so they had the rights to serve us and stream us the music or the podcasts or the audiobooks that we were listening to. In addition, they have various fixed costs like research and development, sales and marketing, general and administrative expenses like their offices and their employees. And the problem is that the costs Spotify incurred in 2022 were greater than the revenue that they brought in. And if you follow this income statement from top, revenue, down to the bottom, you can see that there was a net loss for the year. At the end of the year, they lost 430 million euros as a result of their business operations. Now, how does that relate to the SIE? Well, let's take a look at how a question might show up on your exam. So as we do, I'm going to read that question to you, and then I want you to pause the video. Answer the question to the best of your ability. Why is the right answer right? Why is the wrong answer wrong? Which of the following statements is true regarding the company's financial metrics? For each of the answers that are wrong, can you identify why? All right, have you had a chance? The true statement here is D. And this is what we just talked about, that the income statement reports the sales or revenue, those terms are used somewhat interchangeably, the expenses, other income and costs incurred, and ultimately the company's net income over the period. D is a true statement. Let's break down why A, B, and C are each wrong. Is the net income calculated using a firm's income statement minus its total liabilities? Not exactly. Net income is a company's revenues minus its costs. Now, those revenues are reported on an income statement, as are its costs, but its liabilities is something else. And so the terms in A are pretty muddled, and I'd say inaccurate there. B, the balance sheet shows a company's profitability as of a moment in time. Ooh, I bet this grabs some of you because a balance sheet does show something as of a moment of time, but it's not profitability. What does a balance sheet tell us? It tells us a company's assets, liabilities, and its net worth, or shareholders' equity, as of a moment in time. So B's not correct, but it's got a bunch of things that are kind of accurate there. C asks about working capital as being calculated as a company's long-term assets minus its current liabilities. Well, working capital is the capital that a company has in a one-year period. That's what we're thinking about here. And so it's not a company's long-term assets, it's a company's current assets minus its current liabilities. That word current meaning within a period of 1 year of time. So for these reasons, A, B, and C are each incorrect, whereas D is definitionally accurate as to what an income statement reports. What's your SIE takeaway right here? Well, it is that those are the things the income statement reports.